All right, let's get right into it. If you're buying a home in Florida, you're probably laser focused on that big sticker price, right? But, one of the biggest shocks for home buyers is a totally different number, the final bill to close. Today, we're going to pull back the curtain on those costs, so you know exactly what you're walking into. And hey, the surprises don't always stop once you get the keys. Just listen to this quote from Edgar DeJesus at Treasure Coast Home Loans. This happens all the time. A homeowner is just settling in, and then bam, their mortgage payment suddenly shoots up. That feeling of panic? That's exactly what we're going to help you avoid.
So, how much are we talking here? Well, for a pretty typical $380,000 home in Orlando, a buyer can expect to bring anywhere from $7,600 to a jaw-dropping $19,000 to the table. And remember, that's on top of your down payment. A range that wide is exactly why so many people get caught completely off guard.
But don't you worry, we've got a roadmap. We'll start with that initial sticker shock, then we'll decode the actual bill. After that, we'll solve a very Florida-specific puzzle about who pays for what. Then we'll get a handle on your escrow account, and finally, we'll arm you with a toolkit to take control of this whole process. Sound good? Let's go.
Okay, first up, the closing cost surprise. So when you first apply for a loan, your lender gives you something called a loan estimate. It's basically their best guess. But the final bill, the one you see right before you sign, is the closing disclosure. And yeah, that's where the numbers can look a little different. We're about to see why.
Now for part 2. That closing disclosure can look like an endless list of confusing fees. Seriously, it's overwhelming. But here's the secret. You can make sense of it by just grouping everything into 4 simple buckets.
And to make this super clear, we're going to use a real-world example throughout this explainer, someone buying a $500,000 house with a $400,000 loan. Let's see how this all breaks down for them.
Our first bucket is lender fees. Pretty straightforward. This is what the bank charges you for actually creating the loan. It's the origination fee, underwriting, processing, all that stuff. Now, the key thing here is that these fees can be thousands of dollars different from one lender to the next, so you have to shop around.
Next up, bucket 2, third-party fees. These are costs for a bunch of other essential services that aren't from your lender. We're talking about the appraisal, to make sure the house is worth the price, the survey, to know exactly where your property lines are, and the title search, to make sure the seller actually has the right to sell it. All absolutely crucial.
Bucket number 3 belongs to the state of Florida. These are the government taxes and fees, and let me be clear, these are totally non-negotiable. If you get a mortgage in Florida, you're paying a dock stamp tax and an intangible tax on that loan. They're set by the state, so there's no way around them.
And our last bucket, often the biggest one, is for prepaids and escrow. Now this one's a little weird, because it's not really a fee. It's actually your money that you're setting aside to pay bills that are coming up later. You'll pay for a full year of homeowner's insurance up front, a cushion for property taxes, and the daily interest on your loan for the rest of the month. A huge chunk of your cash goes right here.
So let's put it all together for our $400,000 loan example. Lender fees can be anywhere from $5 to $10 grand, easily. Tack on about $2,000 for those third-party services, another $2,200 for Florida's taxes, plus potential HOA fees and your prepaids, and yeah, you can see just how fast this all adds up.
Okay, on to section 3. Just when you think you've got this all figured out, Florida throws a massive curveball. There's one really big fee that flips-flops depending on a factor you'd probably never guess.
So here's the big question. Who pays for the owner's title insurance policy? This policy is super important. It protects you from any old claims on the property's title. In a lot of states, the answer is simple. But this is Florida, and here, it depends. And what does it depend on? The county you're buying in. No, I'm not kidding. This map shows the local custom, and the difference is huge. In most of the state, it's customary for the seller to pay, but in some of the most populated, expensive counties, the buyer gets to foot the bill.
Let me make this crystal clear. If you buy a house in Orange County, that's Orlando, the seller typically pays. Same for Hillsborough County over in Tampa. But if you buy in Miami-Dade, Broward, or Sarasota, that custom completely flips, and that cost, which can be thousands of dollars, lands right in your lap. It's a massive regional difference that can change your cash to close in a big way.
Okay, section 4. This brings us right back to that panicked homeowner we talked about in the beginning. So many people think their mortgage payment is set in stone for 30 years. It's not, and the reason why is something called an escrow account.
See, your monthly payment is usually made of 4 parts. People call it PITI. You've got your principal and interest, which is what pays down your loan, but then you also have taxes and insurance. The T&I parts of your payment don't go to the bank's bottom line, they go into a little savings account, your escrow account.
Then, the lender uses that money to pay your big property tax and insurance bills for you when they come due.
So your principal and interest, that part's the biggest chunk of your payment for sure, but those slices for taxes and insurance are pretty significant too. And here's the all-important detail. While your principal and interest payment on a fixed loan never changes, your taxes and insurance absolutely can.
Every year, your lender does what's called an escrow analysis. They look at what your property taxes and insurance actually cost this year. And if those costs went up, which is happening constantly with Florida's wild insurance market, they have to collect more from you each month to make sure there's enough money to pay next year's bills. And that is the payment shock that catches so many homeowners by surprise.
So after all that, you might be feeling a little overwhelmed. But here's the good part. You are not powerless in this process. So let's get to Section 5, your homebuyer toolkit. There are absolutely things you can do to take control.
All right, here are the most important takeaways. First, shop for your homeowner's insurance aggressively every single year. Don't just auto-renew. Second, by law, you get to see your closing disclosure 3 days before closing. Read every single line. Confirm all those HOA fees. Make sure you apply for your homestead exemption to lower your property taxes. And remember, you can always negotiate for the seller to pay some of these costs for you. Oh, and a pro tip, ask your lender about closing at the end of the month. It'll save you money on prepaid interest.
And that really brings us to the most important thing to remember, summed up perfectly by a director at the fund, which is a huge player in Florida title insurance. They have a saying, EPIN, every penny is negotiable. Now, sure, government taxes are set in stone, but almost everything else, your lender fees, your insurance, even who pays for what, it can often be negotiated. The only question is, now that you know what to look for, what are you going to negotiate?